Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Chris Versace, co-founder and chief investment officer and thematic strategist at Tematica Research, to discuss how regulators and the Fed are responding to the Silicon Valley Bank fallout and the impact to big regional and community banks. Chris, it's great to see you as always. Welcome back to Trade Talks.
Oh, thanks for having me, Jill.
You got it. Was the failure of SVB an idiosyncratic situation, considering it operated without a chief risk officer for nearly a year? Or is this the first shoe to drop in the banking sector, as it could be more of a systemic issue for the system and other industries like commercial real estate? What are your thoughts around that?
So there's little question in my mind that operating without a chief risk officer was certainly a key factor in what we saw at Silicon Valley Bank. However, when we think about what led it to embark upon what turned out to be a failed capital raise, there are other banks that are clearly struggling with that. And since initial salvo with Silicon Valley Bank, what have we seen? Signature Bank and others. Clearly, there is a ripple effect to be had here. And I think over the weekend, what we saw with 5 central bankers come together tells us that there is the possibility that there's another shoe, 2 or 3 perhaps even, to drop. So we have to be on guard here. My sense, though, is that for bulge bracket banks, your Citigroups, your Bank of Americas, JP Morgans, this is going to be an opportunity to grab market share and do so in a very, very easy way, if and only if, because people are nervous about the bank that they're currently having their deposits in, and already we've seen billions of dollars start to move to these bulge bracket banks.
Do you think legislators and the Fed will tighten restrictions as it relates to stress tests and capital requirements, perhaps even rethink mark-to-market?
I don't see how they can't do something. Could be one of those, could be all 3 of those. And I think, again, that kind of speaks to the competitive advantage that large banks have these days. Again, that same list that I just rattled off.
And Chris, with these larger banks, my question is, how will this impact the overall economy? Because I believe about 40% of lending originates from community banks, smaller banks, regional banks, and we know how important small businesses are to the U.S. economy. Could there be an impact there?
I think there's actually going to be one. And really, the way I think it's going to play out is that as the restrictions and other things tighten on these smaller banks, more of a critical eye, if you will, people will and companies will start to move to those bulge bracket banks, but there's going to be a time gap there. There are procedures to follow, loans to be processed, approvals to be had, that sort of thing. And my suspicion, Jill, is that in a few months, when we look back, we're going to see a little bit of a speed bump here with the economy because of that. Now, we haven't seen a pronounced slowdown in the economy yet. Right? With the data for February retail sales has pointed to a little bit of a slowdown, but nothing dramatic, no sense that we're falling off a cliff. So there are some folks that are seeing what I just described and thinking, oh, another concern about a recession, but so far the data hasn't borne it out yet.
What do you think the Fed's going to do on Wednesday regarding interest rate hikes, and how do you think the market will interpret any of those scenarios?
Okay, so now we get to the big question, right? So I'm sure you've looked at the CME Fed Watch tool like I and just about everybody else has, and it calls for a 25 basis point rate hike. That seems to be the consensus. If we go out to the next meeting, it looks for a pause. And then where it gets tricky is the June and July meetings are actually calling for 25 basis point rate cuts each. Now, this is where I'm going to differ from the CME Fed Watch tool, because when I looked into the February CPI report, and you look at core CPI on a month-over-month basis, it is clearly heading the wrong direction. And by that, I mean it is actually up month-over-month for the last few months. Now, the Fed is going to see this. I would also say that if you dig really deep into the February PPI report, you see the same thing for services inflation. And again, the Fed is going to see this. So what I'm concerned about is that the market is thinking, oh, boy, we're going to get these rate cuts. Things are going to be great. But as we've seen, over the last year or so, whenever the market has to reset expectations based on what the Fed is going to do to tame inflation, it's not a very good time for the market. It gets a little rocky, gets a little painful. And my concern is that this is going to happen. Powell will say, we will continue to do the job until the job is done. And the market is going to have a bit of indigestion. That's why over at Action Alerts Plus, the portfolio I co-manage, we actually are continuing to hold high levels of cash and some exposure to inverse ETFs, at least until we ride out this next period.
Yeah, Chris, I would agree with you too that the market perhaps is getting ahead of itself. It seems really disconnected from the Fed messaging. It wants one thing, but seems as if Powell's going to deliver something else, regardless of the data. I don't think he would. Perhaps no more rate cuts, but to completely reverse course. I don't think he wants to make that mistake of policy shift that drastic. Again, we saw what happened with how fast rates moved higher, but you don't want to make the mistake the late 70s and early 80s where it spurred on inflation by reversing course that quickly. I feel like the market is not listening to what Powell's trying to tell it.
Wow, that wouldn't be the first time over the last several months. And I agree with you too. They have been emphatic about even when they stop holding rates at elevated levels for a prolonged period of time. And if we go back and trace, Powell's own comments during the press releases, he continues to warn against exactly what you just described. I don't see how they're going to have those rate cuts in June and July.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.